Okay, next we have master budgets, which means budgets that are prepared for the whole organization. They cannot be prepared for a specific department. It would not make sense to make it for a specific department. We already saw departmental budgets or functional budgets. So in master budgets, we have a cash flow budget and SFP budget and P&L budget. So 3 things. And then at the end of this video, we will look at flexible and fixed budgets. So the way that they will come in exam, obviously, you don't have to prepare the whole thing. But preparing a whole thing means that you understand every aspect of it. So when you are practicing, make sure you practice the whole thing as well. Or what you could do is, for example, take this format and redo everything that I have done. So you don't have to necessarily remember everything, but by practicing like this, you will know what comes where. So let's start. Obviously, we will look at kit questions as well, which will show you how they come in exam. But again, remembering the whole structure means that you understand every aspect. And remember, budgets, they don't come in paper F5 or in P5. So the level of knowledge that you need in F2 is far more than the level of knowledge that you would need in F5 or P5. So F2 would be assumed knowledge. So you don't have to worry about remembering these format in any of the papers. So what you do here, that would be enough for your future papers. What comes more in those papers is the application bit. So they will not want to know how you prepare budgets, but they're more interested in knowing whether you understand it or not. Okay, so we have cash flow budget or forecast. Remember, the difference between a budget or forecast is they basically mean the same thing, forecast or budget or standard. But the difference is cash flow forecast would mean the cash flow that we expect that will happen. And from that forecast, we would make a budget. So they are necessarily the same thing. Budget is what we plan, and forecast is what we expect. So obviously, one part of the preparation of budget is doing a forecast. So once you do forecast of the sales that you're going to be making, from that you can make the production and those other budgets we studied. So cash flow forecast or cash flow budget, they are necessarily the same thing. So we are basically looking at the cash that is going to come, which is inflow and outflow. Okay, so required, prepare cash budget for 6 months to 31st March 2014. So remember, in cash flow, we are only interested in cash. We are not interested in the profit. With accrual-based accounting, remember, accounting is based on accruals concept, which means that profit made or income earned might not be actually received, or maybe it is received in advance. So in cash flow, we are only interested in the part where the cash is received or the part where the cash is paid. So we are preparing budget for 6 months up to 31st March 2014. That means it would start at October, November, December, and then January, February, March. Peter Blair has worked for some years as sales representative, but has recently been made redundant. He intends to start up in business on his own account using $15,000, which he currently has invested with Building Society. Peter maintains bank account showing a small credit balance, and he plans to approach his bank for the necessary additional finance. Peter asks you for advice and provides the following additional information. So basically, Peter wants to start business. He has some cash that he has invested, and he also wants to know how much more cash he will need. Arrangement has been made to purchase non-current asset costing $8,000. This will be paid for at the end of September and are expected to have a 5 years life, at the end of which they will possess nil residual value. It doesn't matter whatever the life is. What matters is, it doesn't matter when we purchase it. What matters is when we are making payment. The reason they've explained this part one is to confuse you. Another thing is the same question we will do for P&L and SFP as well. You will see this information is used there, but not in cash flow. Inventory is costing $5,000 will be acquired on 28 September, and subsequent monthly purchases will be at a level sufficient to replace for cost sales for the month. So 5,000 will be purchased inventory on 28 September, which means before the start of our 6 month budget. And then subsequent monthly purchases will be at the level sufficient to replace for cost sales for the month. So initially we buy 5,000, then every month we buy as much as we are selling. So obviously, remember, when we are buying, we are paying the purchasing cost, and when we are selling, we are receiving the sales price. For costs, monthly sales are 3,000 for October, 6,000 for November and December, and 10,500 from January onwards, which would be 3 months. Selling price is fixed at a cost of inventory plus 50%. Cost of inventory means cost of goods plus 50%. So this is markup. When profit is shown as a percentage of price, it means it is markup. 2 months credit will be allowed for customers, but only 1 month's credit will be received from suppliers of inventory. So we will give our customers 2 months to pay, but our suppliers only have allowed us 1 month to pay. Running expenses including rent, but excluding depreciation. So it doesn't include depreciation. If depreciation was included in it, we would have removed it. So we don't have to remove it because it is already not included. Are estimated at $1,600 per month. They didn't say when we are paying this. When they don't say when it is paid, it would be assumed that it is paid in the month it is incurred. Blair intends to make monthly cash drawings of $1,000. Now we will be withdrawing $1,000. Remember, in profit, it doesn't matter because drawings is not an expense, but in cash, it matters. So the difficult part in cash flow, the thing where you would need calculations or workings, is the part, the money that is received from the sales and the money that is paid for purchases. And in multiple choice questions as well, the numerical especially, it would be usually about those two things. They will ask about when money is received from sales and when money is paid for purchases. Okay, so I've made a format here from October to March. Remember, 6 months is told. We don't care what happens here. We don't care what happens there. So I need working for purchases and sales. I don't need working for anything else. That's straightforward. Okay, first let's look at sales. For cost, sales are 3,000 for October, 6,000 November, December, 10,500 onwards. So we have 3,000 6,000, 6,000, and 10,500, 10,500, 10,500. Now remember, they said here 2 months credit will be allowed to customers, which means that our customers will pay 2 months later. So the sales that we have made in October will be paid 2 months later, which means November, December. Then November will be paid in January, December, and February, and then January and March. And then February will be in April. But remember, April is not in our 6 months budget. So we will only be able to receive money from the sales for the first 4 months. Because we are giving 2 months credit, first 2 months, they will be received, but in terms of the money received, there will be nothing. So we have basic format. Remember, this is very simple. It is not like statement of cash flow. You have inflows on one side, outflows on another side. Simple as that. So in inflows, we only have the sales, 3,000 from October received, 6,000 and 6,000, and then 10,500. And the rest is not received. Okay, so this is the only inflow. I can total it. It will give me net inflows. Let's look at outflows. In outflows, one thing that is complicated is purchases. And remember, in purchases, what is important is when we are making payment for the purchases. One thing is we are purchasing every month as much as we are buying, and another thing is we have already purchased at the start as kind of inventory 5,000 on September. So one thing we have purchased is 5,000, and we receive 1 month credit. That means it will be paid in October. September will be paid in October. And then we buy as much as we are selling. So we are buying 3,000. But remember, we are not paying 3,000 for it because 50% profit is on the sale. So divide by 150. Remember, it is markup. If it were margin, I would have divided it by 100 and then multiplied by 50. But here I will divide by 150, multiply by 100. So I will drag it. So this 2,000 will be paid in November, November and December, December and January, January and February, February and March. And then March will not be paid because we have only 1 month credit received. So 1 month is not paid for purchases and 2 months is not received for sales. So I'll write it here, 5,000. So if 2 months are empty here, 1 month should be empty here as well. But the reason it is not empty here is because we have made this purchase in September, like in advance. So only last month's purchases is not paid. And then running expenses is 1,600 per month. We have drawings, 1,000 every month. Adding it together, we have net outflows. And when we take inflows minus outflows, it gives us net cash flows. In the first month, we have 7,600 outflows. One reason is because it has purchases of September as well. Then it becomes 4,600, 3,600, 600, and then 3,600 and 900. Let me make sure that I've done that correctly. Yeah, at the end it becomes more because we have increased purchases here. Okay, opening balance, we have 15,000 cash, but 8,000 is paid for machinery in September. So the opening cash that we will have in September would be 15,000 minus 8,000 that we paid for machinery. So our net cash flow would be negative 600. This will be closing in October, and what is closing balance becomes opening next month. And it goes on like that. So this negative balance keeps increasing. So only at the 6th month this amount become positive. And at the end of 6 months, we have 12,100 cash. So our advice would be 12,100 should be borrowed. But remember, for a brief period of 1 month, $900 is needed. But it doesn't have to borrow 13,000. So 900 extra is needed here. Maybe he can arrange it from somewhere else. But overall, for the 6 months, 12,100 is needed. So this is cash flow, simple, nothing complicated. The only complicated thing about it is when cash is received. So format, simple. You're not expected to produce this format because exam is limited. Okay, so this is cash flow. Now let's look at P&L and SFP budget. So we will make a budget from the same question. Okay, same exact thing. And see, at the end they have given us, the only difference in this one is that they have given us the cash, because now we are preparing the P&L and SFP, so we need the cash bit. Okay, so let's start with P&L. So you should already be familiar with this. The formats that you have in F2 are easier than the formats that you have in F3. Okay, sales. Now in sales, when we are doing P&L, it doesn't matter when we are receiving money. What matters is the sales. So when we are recording sales, we record the whole bit, 46,500. Even though 2 months is not received, but it doesn't matter here. And then cost of sales for this one. Remember, this 5,000 that we have at the start, we haven't sold that, so we will not include that in cost of sales. Even if we have sold it, obviously the other will be replaced, and they will be replaced. It will replace the 5,000 the next sales and the next purchases that we make. So the idea is this 5,000 will be there. So what we sell is 31,000. Or the easiest thing to do is, because cost of sales for all of the sales is the same, we could divide by 150, multiply by 100, which should give us the same thing. So sales minus cost of sales gives us gross profit, and then we minus other expenses. You could add all of these. Or what you could do is 1600 multiplied by 6. Remember, we are preparing this for 6 months, not for the whole year. And drawings doesn't matter here because drawing is not expense. So what matters is depreciation. Remember, we bought equipment for 8,000 and it is going to be used for 5 years, and we only need 6 months. It will give us depreciation of 800. So after minusing other expenses, we have 5,100 net profit. Now let's look at the SFP. So we have assets, non-current and then current. In non-current, obviously, the only thing is the asset that we have purchased. And then in current assets, we have inventory and receivables. And then we have capital adding profit and loss and liabilities and stuff. Let's look at non-current assets. We have 8,000 minusing the depreciation of 800. That means we have a net book value of 7,200. And then current assets, remember, if everything is sold, this 5,000 is not sold, so that 5,000 is inventory. Remember, it doesn't have to be that exact 5,000 that we bought at the start. So generally we have 5,000 remaining in inventory. So 5,000 and receivables, October receive in December, November in January, and then December and February. But the easiest thing is we have received this, we have included it in cash. What we have not included in cash is receivable. Simple as that. So the last 2 months, which we haven't received, is receivable. Adding together 26,000 current assets, 33,200. Now let's look at capital and liabilities. Let's start with opening capital. Remember, what we start with is 15,000. Even though the cash was 7,000 opening, but our capital was 15,000. And then we have profit made. Even though cash is negative, but we have made profit. Drawings of 1,000. It matters here. It decreases our capital. It doesn't matter in profit. 14,100 is closing capital. And then liabilities. If at the end of the 6 months we would have negative 12,100, it means this is how much we would have borrowed. So 12,100. And then one last month that is not paid would be payable. So we have assets equal capital and liabilities. So this is master budgets. I will do fixed and flexible budgets in another video.